Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. I have had a cold for a few days since I came back from Hajj, and it feels like every couple of days it just kind of multiplies itself. It's like a proper virus, like in computer virus, it just like replicates itself. That's exactly what this one is doing. There's different dimensions of this cold, but Alhamdulillah, I'm getting through. I'm okay now. I'm getting there, but my voice is still all over the place. But you know what? Life goes on, and I'm going to carry on recording as much as I can, because I've got a holiday coming up and I might not be able to record as much or post as much. So I'm going to definitely record as many as I possibly can now, and then inshallah you will see that in the channel in the next few weeks. Now, today's video, I'm going to talk about 5 different companies that are undervalued at the moment. Okay, and when I say, by the way guys, undervalued, it's not based on some sort of a discounted cash flow model that I did myself. I use websites like Morningstar, for example. Morningstar is one of the, I think, reliable websites that I use. Okay, their valuations is quite normally it's quite good. So if they give a stock, for example, like a 4-star, for example, they'll tell you how the discount basically. So they'll say to you, oh, 10% discounted right now. They'll say fair value. Okay, this is where it should be. This is where it closed last time. It will tell you what it has, a wide economic model, and they will give you the idea why they have actually come to that conclusion. And when it comes to valuations, this is one of the things they basically give you. Okay, so if you click valuations, they'll tell you exactly. Morningstar calculates the fair value estimate of a company based on projection of how much cash the company will generate in the future. And that's basically what you do in the discounted cash flow model, which is basically what they talk about there. Okay, so they talked about that. They do all that legwork for me. So for that reason, I actually don't bother doing it in my own one, because remember, what you're doing is you're estimating. You're estimating basically what the company, okay, how much cash the company will generate in the future. And that's a little bit tricky. Okay, the model is not that difficult to get your head around, but the thing is, you're predicting something, you're estimating, and that can be sometimes tough. So instead of doing that by myself, which some of you suggested recently, okay, I'd rather honestly use the professionals that have come up with this, and I can see they are using that. Okay, they are using the discounted cash flow model. So why do I have to reinvent the wheel? I don't have the time to do that. And number one, it takes a lot of time to actually prepare these videos as it is already. So I use this. So when I say discounted right now and by discount, I'm talking about based on what Morningstar says, especially like when you look at here. I always say to Morningstar valuation and their fair value. I never say this is my valuation. Okay, so you have to just understand that. And then obviously, if the price was, say for example, 326 for this company, then I will add margin of safety. So I might say maybe 5% off that, 10% off that, or whatever it is that you want. Okay, depending on the company. So if it's a high flying company, technology company, I normally tend to do about basically 10%, 15%. If it's basically consumer staples, basically one of those basically, for example, Procter & Gamble or Unilever or whatever, I'll just do 5% because the risk is not huge there. But margin of safety is very important. So I just want to make that clear, because I'm going to talk about 5 different companies that are undervalued at the moment based on Morningstar valuations. And I said to you, and also I will also look at companies where websites like Seeking Alpha, which I will be doing today, and I'll share that with you as well. Okay. Right, if you haven't actually liked the videos, it honestly takes a lot of time to prepare these videos. So the best thing you could do is just to give the video a like, subscribe to the channel, and let me know if you have any questions. And also, if you can join us on the Discord, it really does help the channel. Okay, let's get started with the first stock. Now, what we're looking at is every single one of these companies, right, have a safe dividend. They are undervalued at the moment, and they do have a safe dividend. So that's the main focus. So we're looking for 5 companies that have a safe dividend, undervalued at the moment, and obviously might be a good addition to your portfolios. And the first one is the one that we were just looking at in Morningstar, and that's Public Storage. And this is one of the companies that I own already in my portfolio. It has 51 billion market cap. It has a no moat, if you think about it. Price $292 per share right now, and dividend yield over 4%, which is quite good. The payout ratio for this company is basically 64%, okay, which is quite low for a REIT. Latest increase was 50%, but they don't have a 5-year growth rate because I think they recently cut the dividends. Okay, and obviously these two are zeros now. Annual payout is basically $12. So every share of this company that you own, they will give you $12. Safety is 96%, which is quite high. 99 basically is the highest. Profit margin, we're looking about 96.3, which is very, very high, and return on equity is 73%. Free cash flow, they have $2.7 billion, and total return in the last 10 years almost 10%. Growth estimate for next year is about 7%, and then after that 17% according to Seeking Yahoo Finance. Morningstar says about 10% discounted, like you've seen already. $326 per share is where the price is at. One other thing I want to show you quickly is if you look at the Seeking Alpha, go to ratings, you can see here, okay, the rating summaries basically for Seeking Alpha, an analyst, as well as Wall Street and quant system. All of them are saying either buy or strong buy for this company. And when you look at Wall Street, their price target is actually 15% upside from where it is right now. It's $338 per share. The next company that we're looking at, and in fact, one other thing I want to talk about is shares outstanding, and that is basically, it's been static for a while now, so nothing huge to report there. The next company we're looking at is Cummins. Cummins is one of the companies that I also own in my portfolio. Basically, they make, they used to make diesel engines, but they're now trying to diversify away from that. 334 billion market cap. It has a narrow economic moat, $248 per share. Dividend yield of 2.5, which is quite good. Payout ratio is only 34%. Latest increase was 8%. 5-year growth rate of 7%. 17 years of increase in that dividend. Okay, annual payout we're looking at about $6.28. Safety 98%, which is up, one of the reasons we're looking at this, and also is basically counted at the moment. Profit margin we're looking at about 8%. Return on equity 28%. Free cash flow 1.3. Return on equity 10%. And growth this year they're expecting basically -1, so it's not there. But then after that, every single year, so that's for next year by the way, not this year. And then after that, basically every single year they're expecting about 12%, which is absolutely huge for this company. And this is one of the reasons, basically one of the reasons this is happening is because they're trying to diversify away from the diesel and coming up with a lot of renewable, basically, side of things. As you can see, it's 1% discounted right now. $248 per share is where the price should be. All right, looking at Seeking Alpha, you can see the ratings. Okay, Seeking Alpha is actually saying hold. Wall Street is saying it's actually a buy, and Qualcomm is actually saying a buy as well. And basically Wall Street is actually saying about 2% and upside right now, which is basically similar to what Seeking Morningstar is saying at the moment. And looking at simply Safe Dividend, you can see shares outstanding. It has been declining for quite some time, which is really nice to see. The next company we're looking at, Pfizer. We've talked about this company so many times. 207 billion market cap. It has a wide economic moat. Basically $36 per share. It has come down quite a bit, and it's almost a 4.5% dividend yield, which is really huge. The payout ratio is basically only 26%, and latest increase was 2.5%, and then 5-year growth rate of 5%, and dividend growth streak of 12 years increasing that dividend. Annual payout $1.64, 75% safety, profit margin 31%, return on equity 31%, free cash flow of $20 billion in the bank right now. Total return in the last 10 years, we're looking at about 6.26%. Growth estimate for next year is 4%. After that, there's a bit of a decline. Obviously, because of COVID vaccine and all of that stuff, the company is going through some changes. And obviously, that was expected to happen, okay? There was a demand for that thing, and it went to the roof, and it has to come back down. There is still a bit of a demand for it, but it's not going to be exactly the same, because we're not locked away anymore, right? And 24% discounted right now, 48%. Basically $48 per share is where the price should be for this company. And looking at Seeking Alpha, as you can see, the analyst is actually saying it's a buy. Wall Street is saying it's a buy. Quant is actually saying hold. And looking at Quant, basically it's about 26% discounted right now. $46 per share is what they expect. And shares outstanding, as you can see, is declining as well. The next company we're looking at today is Nike. Nike is one of the companies that I've talked about, or Nike, whatever you want to call it. $170 billion market cap is a new addition to my portfolio. So if you haven't seen that video, go and watch it. It has a wide economic moat. $109 per share. Dividend is 1.24. It's not a lot, but it's a fine. Payout ratio, by the way, this is a different, basically this is a dividend growth, I can't even say the word, dividend growth stock, basically. Okay, so this means although the yield is quite low, okay, basically they are increasing it. So the fact that they actually latest increase was 11%, and the 5-year growth rate basically is 11%, is actually double digits, is absolutely amazing. So normally when I see stocks like this, I don't worry about it, okay, because they will increase it in the long run, and they do have that basically momentum. They've been increasing that for 20 years, which is really good. 5 more years, this big company will become a dividend aristocrat, meaning the company that has paid it or increased that dividend, paid and increased it for 25 years in a row. Okay, and you've got dividend kings, which have increased their dividend for 50 plus years. So they take pride in these things. So the yield, I wouldn't worry too much about it. I never honestly look at the yield and say, oh, I don't want to buy this stock, because in the end of the day, for me, it's not about the yield, it's that dividend growth history. Because in about 10 years, 15 years down the line, I want to look back, basically look at my yield on cost and say, okay, that was really good buy at that point. In terms of annual payout, you got $1.36, safety 99%, profit margin of 11%, return on equity 37%, sorry, free cash flow $3.8 billion, total return. I thought they might have actually a little bit more cash than that, actually, for a company that is $170 billion, but it's fine. Total return in the last 10 years, we're looking at about 14%. Growth estimate for next year 19%, and then 8% after that, which is decent. And Morningstar is saying it's about 20% discounted right now. $138 per share is where the price should be. And looking at Seeking Alpha, as you can see, Seeking Alpha analyst is actually saying is a hold. Wall Street is obviously saying is a buy. Quants is actually saying is a hold. And when we look at this, about 18-19% upside from where it is right now. And then shares outstanding, as you can see, has been declining over the last few years. Final company we're going to talk about today is another one that I actually own in my portfolio, and that's Qualcomm. Qualcomm is basically 133 billion market cap, and it has a narrow economic price right now is $120 per share. Recently was about $100 per share. Right now it's gone up quite a bit in the last 2 weeks. Dividend yield of 2.67%, which is really good for a technology company. Payout ratio only 28%, so they have a room to improve that if they need to. So they can increase this as much. So out of their net income, they're using about 28%. That's what it means, by the way. Okay, so they're using about 28% of their net income to actually pay as this dividend. If they want to increase that, they can. Okay, so some companies, what you can see about 60%, they spend 60% of that. I like when the companies are still doing this and they still have a room to improve. Obviously, latest increase was 7%, which is really good. 5-year growth rate of 5% and dividend streak of 19 years. Now, this is also becoming soon enough. It will become dividend aristocrat. $3.20 is what you get for every share of this company that you own. 80% safety, profit margin 25%, return on equity 58%, and cash we have now $6.85 billion in the bank. Total return in the last 10 years, we're looking about almost 9%. Growth estimate for the next year, basically 16%. And after that, there's a bit of a decline, and that's basically quite common for these companies, and especially in the semiconductor companies. They are going through a bit of a phase. They are very cyclical, meaning sometimes they're basically products are in demand, sometimes they're not. So right now it's basically that flat basically few years, and then obviously they will bounce back, because remember, every single device that we have in this world right now needs some of the basically chips that basically these companies make. Okay, right now when we look at the Morningstar valuation is about 15% discounted. $140 per share is where it should be. It's $120 right now. And looking at Seeking Alpha, as you can see, Seeking Alpha analyst is actually saying it's a buy. Wall Street is a buy, and their system is actually saying it's a hold right now. Actually, Seeking Alpha is saying it's about 12% upside from where it is right now, and they have been buying back their own shares, which is absolutely amazing. Final thing I want to talk about is from Sharia compliance side of things. Every single one of these companies meets that criteria. This one has a little bit debt, okay, but again, Zoya actually uses, okay, basically last quarter, whatever. So instead of using that, basically you could use a 36%, 36 months instead of that. So if you don't know what I'm talking about, go and get this Sharia compliant investing ebook. Okay, there is a section on different types of basically Sharia compliant scholars, or whatever you want to call them, that have put together these things. Okay, different companies and so on. So have a look at that and use that. But either way, they are all Sharia compliant. Just to be transparent, just to show you, I own every single one of these companies. Pfizer is actually a new addition to the family portfolio since it's gone down quite a bit. I added there because there was not that many healthcare companies there, so I own that one in the family portfolio. And this one, 3 or 4, I do own them, and I will show you very quickly just to be transparent. Cummins is there. Okay, I basically own about 17 shares of Cummins. I own, where is it, Nike there, Public Storage, and Qualcomm. All 4 of them are in this portfolio, and these 2 I'm actually down, and the other 2 I'm actually slightly up. Anyway, I'm going to stop the video there. I've got loads of more videos coming up. If you haven't liked the video already, please do it. It really genuinely helps. And if you haven't joined us on the Discord and the Patreon account, please do so, because genuinely helps the channel. Have a wonderful day. Assalamu Alaikum.